Ready for a deep dive? We're tackling The Intelligent Investor by Benjamin Graham.
A Wall Street classic.
It's wild how relevant it still is.
You know, it's fascinating.
What is?
Graham wasn't trying to create like an army of day traders or anything.
Right.
His whole concept of intelligent investing, it
Yeah.
wasn't about some secret formula or it needing to be like a math whiz. It was something way more surprising, actually.
Really? Okay, now I'm really curious. What's so surprising about this intelligent investing then?
Well,
Yeah.
Graham truly believed it was less about your IQ and more about your temperament, you know?
Okay.
He had this famous line, he said, it's more a trait of the character than of the brain.
So you're saying it's not about being like some stock-picking genius.
Exactly.
It's about mastering your emotions.
It's about patience, discipline, not freaking out when the market dips.
Which it always does, eventually.
Right. And speaking of freaking out, we've all seen what happens when people get caught up in the hype. Remember that whole .com bubble?
Oh, man. Don't remind me.
Well, Graham, he lived through similar stuff.
I bet.
He even tells this crazy story. This company, Savold Tire,
Happened.
he made a 250% return on them
No way.
in a single day back in 1919.
250% in a day. That's insane.
Right. But here's the thing.
Bro.
A few months later,
Oh.
totally exposed as a fraud.
Oh, no.
Yeah, the story, it just shows why Graham put so much emphasis on temperament, you see?
Yeah, even he got caught up in it, huh?
Even someone with his experience, it's a reminder, gotta be cautious, even when things seem almost too good to be true.
Yeah, that's a good lesson. I
Yeah.
mean, it's easy to get swept up in the excitement of it all, you know?
Yeah,
But like you said, keeping a cool head is key.
it is. And to drive that point home even harder,
Okay.
Zweig, who wrote the commentary for the book, he uses a more modern example. The Monument Internet Fund.
Oh, yeah.
During the .com boom, everyone thought internet stocks, easy money.
Sure.
And that fund lost 80% of its value when the bubble burst. 8-0.
Ouch. So the message is clear. Don't get blinded by the hype, no matter what era you're in, right?
Exactly. Being intelligent the way Graham saw it, it meant tuning out all that noise.
Okay.
Sticking to your strategy,
Yeah,
not letting your emotions make decisions for you.
makes sense. But does that mean everyone's supposed to follow the same exact strategy, or what?
Well, that's a thing. Graham knew that we're all different, right? Different personalities when it comes to investing.
That's true.
So he actually outlined 2 main investor profiles.
Oh, interesting. Tell me about these different profiles. So you're saying there are different ways to be an intelligent investor.
That's the idea. It's not one size fits all.
Okay, makes sense.
He calls them the defensive investor
Okay.
and the enterprising investor.
So defensive versus enterprising.
Yeah, so the defensive investor, they're more passive.
Mm.
They're cool with having a simple portfolio,
Okay.
diversified, you know, the drill.
Stocks, bonds, the usual.
Exactly. They're not glued to the computer obsessing over every little stock move.
Okay. Yeah, that sounds like a lot of people, actually.
Right.
Myself included, maybe.
Well, hey, nothing wrong with that.
True. So what about these enterprising investors then?
All right, so the enterprising investor, they're more hands-on.
No.
They're willing to really put in the time to
Yeah.
research companies,
Really dig in.
trying to find those hidden gems, you know?
The diamonds in the rough. So which style is better?
See, that's the thing.
What is it?
Neither one is inherently better.
Oh,
It all comes down to you.
yeah.
Graham's whole point is you got to choose the path that vibes with your personality.
Okay, so like if I'm not someone who's going to spend hours every day researching stocks,
Exactly.
I'm better off sticking with something more passive.
Exactly. You could be super successful as a defensive investor.
Mhm.
Or if you're more gung-ho, go the enterprising route. But the key is you got to stick with what works for you.
Okay, that's actually kind of freeing in a way.
How so?
So often it feels like you're supposed to chase the hottest stock tip or be glued to the market 24/7.
Right.
But Graham's saying, know yourself,
Yeah,
be real about your investing style, and you can still kill it.
exactly. Now, no matter which profile you're more into, defensive or enterprising,
Okay.
Graham was big on this concept.
Yeah.
He called it margin of safety.
Margin of safety. Okay, yeah, that's one I've heard thrown around a lot in
Yeah.
investing circles and all. But what does it really mean, though, like in plain English?
Okay, picture this. You're at a flea market.
I love a good flea market.
You find this vintage watch, right?
Okay.
Seller's asking $100 for it,
All right.
but you're pretty darn sure it's worth at least double that
Nice.
that difference, that extra 100.
Yeah.
That's your margin of safety. You're
Yeah.
basically buying something for less than it's actually worth.
So if it turns out to be a fake or something.
Exactly. You've got that cushion. You're not losing your shirt.
That's a good way to think about it. It's like finding a dollar bill just lying on the ground.
Right. And Graham, he believed in applying that same logic to investing, finding companies that were trading for way less than their real value.
So he's out there looking for bargains.
Big time. He wanted that margin of safety, just in case.
Makes sense. But here's a thought. Does that margin of safety even exist anymore? Like, today, the markets are so fast-paced, everyone's looking for an edge. It seems like those obvious bargains would be long gone. You know what I
But,
mean?
that's the million-dollar question. Zweig actually digs into this in the book.
Does he?
He points to this chart. It's fascinating.
Oh, yeah.
It shows stock market returns, but only from 1949 onwards.
Okay.
And when you compare it to what Graham saw in the 75 years before that, totally different story.
Interesting. So what does that mean in plain English?
It makes you wonder, has the market fundamentally changed somehow, making it near impossible to find that margin of safety anymore? Or are there still opportunities out there, like hidden pockets just waiting for someone who knows what to look for?
Okay, yeah, I'm following you.
Yeah.
So how do we even start to find those opportunities? Like, what did Graham actually do to put these principles into action?
Well, Graham, he was big on laying out specific strategies.
Okay, like a roadmap for investors.
Exactly, for the defensive investor.
The more laid-back type.
Right. He kept it super straightforward. A diversified portfolio, stocks and bonds, the classics.
Keep it simple. I like it.
Exactly. Don't overthink it.
Right.
And one thing he really emphasized, super relevant even today.
Yeah.
Dollar cost averaging. You familiar with that one?
I've heard of it, but honestly, I'm a little fuzzy on the details.
It's easier than it sounds. Instead of trying to time the market perfectly.
Which, let's be honest, is basically impossible.
Pretty much. You invest a set amount of money at regular intervals, like every month, every quarter, whatever works for you, no matter what the market's doing.
So even if it dips, you just keep buying in.
Exactly. You're not freaking out about the short-term ups and downs.
I can see how that would be less stressful.
Way less. And the cool thing is, over time, since you're buying more shares when they're cheaper
Yeah.
and fewer when they're pricier, you're naturally lowering your average cost per share.
That's actually pretty clever.
It's a classic Graham move. Discipline over trying to be a market wizard.
Love it.
Huh?
Okay, so that's defensive. What about those enterprising investors? What did Graham have up his sleeve for them?
All right, so for those folks, the ones who love to roll up their sleeves and dig in.
The treasure hunters.
Exactly. Graham was all about finding those undervalued companies.
Okay, but how do you even do that? Isn't that like the holy grail of investing? Finding those hidden gems.
Well, one thing Graham looked for were companies trading for less than their net working capital.
Okay, now you're just using fancy words to confuse me.
Haha, sorry. It basically means you're buying the company's assets for less than what you'd get if you just liquidated them.
So it's like the company's worth more dead than alive, but you're getting it at a discount.
You got it.
Yeah.
He actually called these net nets. And, he tells this story about Northern Pacific Railway.
What about it?
Back in the 1940s, it was selling for less than its net working capital. Can you imagine?
Those are the days, I guess.
Mhm.
Finding a deal like that today seems unlikely.
It's definitely rarer, but the principle still holds up. It's about finding those overlooked opportunities where the market's undervaluing something truly valuable.
I like it. So net nets, that's one tactic. What else did Graham suggest for those enterprising investors?
He was also a fan of special situations.
Okay, what are those?
So these could be anything from mergers, spin-offs, bankruptcies even, situations where there's a catalyst that could unlock a bunch of value.
Okay, but that sounds pretty high stakes.
It can be. And to be fair to anyone listening,
Yes, please.
while these strategies can pay off big, they also need a deeper understanding of how the markets work.
It's not just throwing darts at a board anymore.
Not quite. You got to understand the financials, the industry, the whole shebang.
So it's not for the faint of heart or the beginner investor.
Definitely not. And here's another thing to keep in mind. The market's changed a lot since Graham's time, right?
Oh, yeah, technology, globalization, meme stocks, the whole
Totally.
deal.
Exactly. Like with those special situations we talked about, a lot of times it's the big institutional investors who have the upper hand there. Tougher for individual investors to compete.
So is it even possible for us little guys to beat the market anymore? Picking individual stocks, I mean.
$1 million question. And honestly, it's one Graham grappled with himself.
Really?
He knew the market was getting more efficient, harder to find those easy wins. But he still believed there were opportunities out there.
Okay.
For those willing to do the homework, understand the businesses, find those hidden gems with that margin of safety.
So it's less about chasing the next hot stock tip and more about having a solid plan, doing your research.
Exactly like we're doing now, learning from the greats.
There you go. Full circle. So as we wrap up our deep dive into the intelligent investor, what's the big takeaway you want listeners to remember?
Whether you're more of a defensive investor or you've got that enterprising spirit.
Or somewhere in between, probably, like most people.
Totally. Find what clicks with your personality, your risk tolerance, how much time you've got.
It's about finding your own style, right?
100%. There's no magic formula, but there is a way to make intelligent decisions.
And that's what Graham's all about. Not getting caught up in the hype, not chasing quick riches,
Being disciplined, doing your research.
remembering that investing is a marathon, not a sprint.
Well said. And hey, who knows? Maybe this deep dive will inspire someone out there to pick up the book themselves, keep learning, and become a more intelligent investor.
Couldn't have said it better myself. Thanks for joining us on this deep dive, everyone. Until next time.